Hello, guys, and welcome to today's stream. It's going to be slightly different. We're not catching up with the normal news. We will be doing that later on today in around an hour and a half or so. Around about 4 o'clock, maybe 4:30, local time in Dubai, so wherever that is for you. I'm not entirely sure. But I want to jump into, and I believe it's this here. So we want to talk about the Fed. We want to talk about what's going on. And yes, I've moved my camera because I'm not going to be looking direct. I'm going to be looking down quite a lot, actually. But anyway, so let's jump into this. Let's find out, how does the Fed affect the crypto market? Because we know it does. We know whenever we have a CPI, a jobs report, any type of conversation from Jerome Powell, we always have a movement in the price of crypto. And so let's jump in and see exactly what that looks like. I'll open this up here, bring myself further down, flipping my bloody keyboard around. If that's right. I love this laptop, by the way. So good. I think it's like a HP. It's not a bug. I'm not affiliated with them. But if they want to pay me, go ahead, buy one. Not financial advice. Anyway, so look, we have the Fed, and we all know about the Fed, right? These guys. Let me just get rid of that. Okay, pen. Here we go. So anyway, we have the Fed. Their sole job is to monitor monetary policy. And they do that through controlling the supply. As you can see, as we're moving further down this little element here, okay, so monetary policy, they're controlling the supply. They do this through two different ways, guys. One is they control interest rates, and also they need to control unemployment. This might sound weird because it's the Fed, like, what is the Fed doing controlling unemployment? But anyway, it's all to make sure the economy works smoothly. So they do this through the classic Fed fund rate. As we all know, guys, we've all seen this many, many times before. So the Fed fund rate, this is the rate that it costs for central banks to borrow money from each other. Okay, this is just what they do. And also, I'm not going to talk about how they create money, but we'll keep it relatively simple. It's just the cost for borrowing money from each other for banks. Now, this is because we have what's called reserve banking. Now, reserve banking is basically where you're supposed to have anyway, X amount of customer funds. Okay. Now, these funds have to be, in case there's like a bank run or something like this, you can't just give away all of the money that someone has given you, because then if everyone was like, hey, I need my money, and you don't have any, it's going to be a big problem. Okay. Hello, 2008. And this is typically what's called a bank run. This is what we've seen with FTX, for example. So FTX, they basically said, yeah, nah, it's fine. Don't worry about me, mate. What have I done that? 10. That's the weirdest order you've ever seen that. But they're like, we've got $10 billion. It's fine. Don't worry. But actually, they didn't have it. Okay. This was over here at Alameda. Okay. And I didn't plan on getting into this, tangent. But obviously, then everyone comes and says, FTX, give me my money back. Give me my money back. This is what's called a bank run, because everyone's running to the bank to get their money out. And then they say, Alameda, just give us that back and we should all be sweet. But that couldn't happen because Alameda had given it out to someone else, right? And so this is what's called a bank run. Very, very bad in the financial institute. So you have reserve banking, and this is why regulations can be quite good for these type of things. So the idea of reserve banking is obviously you have some money, and then, anything that, if you have more than you're supposed to have, the government say, you have to have $1 billion and you've got 1.5 billion, for example, you can borrow this out. No, you can lend it out, at quite a high interest rate to other banks. Hence why this whole thing starts to make sense. And the idea is, obviously, you borrow at a low rate and you lend it at a high rate. And so lending it out at a high rate, obviously, you start making money, buy low, sell high. So they're essentially buying the currency low by borrowing it, and then they're lending it out high. That's, buy low, sell high. Start making money. Now they're lending it out to two different people. I'm going to cover off customers first. It's a little bit more simple. Obviously, customers, we do things like borrow money to get some investments. Okay, might borrow money, trade some Bitcoin. Most people will lose their money, but fingers crossed you don't. They might go and buy a new house. They might go and buy something that's going to help them in, saving money to go to work. Instead of taking the bus or the train every day, they might buy a car. And if they buy a car, then they save because they don't have to spend on petrol money, for example. But the overall idea here, boys and girls, is that the net worth goes up. Okay, this is the idea for customers. And this means, obviously, if the net worth is going up, then they have a little bit more money. Yeah. And so then they start buying things like Teslas, you know. I know this is the ticker symbol. They might buy a Tesla. They might buy a Gucci handbag, for example. And so in doing all of these, this is called discretionary spending. So the reason why I mentioned why I was interested in Walmart the other day is because when this starts to get affected and customers no longer have any more money and their net worth starts to go down because the Fed raises interest rates, for example, and they can't borrow from the banks the same way they used to, they then start going to things like Walmart. Or if you're in the UK, you might switch from shopping at Waitrose, and then you say, sorry, mate, I'm not paying £400 for a glass of milk. So instead, I'm going to go to the likes of Asda, you know? And we all have these, Aldi, Lidl, it could be, whatever. But these are typically, we go to the cheaper places when we have no money. And so this is what the Fed is looking out for. And this is why I mentioned Walmart is really interesting for me to see that their retail sales have gone up by 9%. And so we're seeing more people shopping at Walmart. That's very good. So we see that the Fed, this whole, squeeze the economy is actually working. But I'm going to bring us back over to businesses and banks. Okay. So businesses and banks, as we see here, obviously, the Fed, they loan out money, but they loan it out to each other. We're not really going to, that we can just pretty much get rid of, that doesn't really interest us too much. But we're looking at overall businesses, which is like, Facebook, could be waste management companies, could be bloody water companies. It could be anyone, right? They start lending out money. Now they lend out and the banks will pay off their debts. They will invest it and they will invest it to try and make their business more efficient. They might buy more machines. They might buy consultants to say, listen, get rid of some of these stuff or change these processes these ways so that you get more use out of your, I don't know, the things that your business sells or uses in order to sell products. Then they also go through R&D. So R&D is new products, updates to current products. It's just research and development. Anything this is going to ideally mean that they can make more money, right? Now, we've just seen that obviously this is a bad thing, right? This is a very bad thing for the Fed. So the Fed are like, listen, mate, I don't want you to make more money. So I'm not going to let you borrow from the banks because I'm going to raise the Fed fund rate. So you see how the Fed, you can already begin to get this. When they start controlling this monetary policy, it starts to affect us down here and it starts to affect the businesses here. Okay. Now, the final element that we're looking into here is this unemployment picture. Okay. So unemployment picture, they go into staff. Now, I brought staff into its own little ratio or its own little section over here. So staff, let's say I've got a job, I'm at company A and I earn $50,000 a year. Okay, fantastic. We go through, a case of COVID, and then the Fed, they say, look, our rates are going to be zero. You can borrow as much money as you want, interest free. Well, that sounds pretty good. And I know a lot of people who've done this, right? So this means that there's a lot of money in the economy. This is called quantitative easing. Okay. So we're making it easier on the numbers. And so there's lots of money floating about. Well, that then means that there's another company, he's just taken out a massive loan. He can then go start and do all this because when everyone's worried about COVID, etc., they were like, right, okay, you need to borrow money, because if you're in loads of debt and you're not selling any extra products, then you're not going to survive as a business. And we don't want businesses closing down because that's going to be really bad for the economy. But this guy who got the money from COVID, let's say, he now can offer me an $80,000 job as opposed to my $50,000 job. Sounds fantastic. But then I might be like, oh, damn, there's another company that's offering $100,000. I've just doubled my salary. This is fantastic. So I'm going to keep doing this. But this is where unemployment gets a little bit tricky because the Fed really begin to look at a couple different things. One of them is this ratio that we have here. This is how many jobs available. So jobs, I don't know if I was going to do it yet, available. And this is versus the people, okay? So at the moment, we are in a 2-to-1 ratio. And this is as of, I believe, last month's jobs report. So we're seeing 2 jobs available for every 1 person looking for a job, which is really bad because if there's, I don't know, if there's like, let's say 100 people here who want a job, there's 200 jobs. How does this guy, how does the job, the HR guy or girl, how do they encourage this? Because they could be easily left in the dirt. Well, what they do is they go, oh, I'm actually company C. I'm going to offer you more money. So this is where we get a job, what's it called? Job price spiral? A wage price spiral. I had just looking at jobs. It's got my head in. But it's called a wage price spiral because these guys have to offer more dollars in order to entice the same people. Ideally, what we want is we want like a 1-to-1 ratio. Okay, so yes, people can move freely in and out of jobs, but it's not a very demanding market where you have to pay more. And obviously, look, if I'm over here and if I'm a business and then my staff costs suddenly go up by, I don't know, let's say 50%, then I'm like, right, well, Jesus, well, what am I going to do? Well, I need to make that money back. So then what I do is I raise my prices. So then all of the prices of my products go up. I think we've seen this. This sounds very familiar. This, my friend, is inflation. So we get more of this. So this is why, and this is, bear in mind, the inflation has only just come into the picture, okay? But this all came from the Fed giving out 0% Fed fund rate, okay? 0% borrowing rate. So then we go through all of this process, bomb. We go down here. The customers start building their net worth. The banks then start, they start doing R&D. They're getting new products, updates, machines, consultants, whatever. And then we start into this wage price spiral. And then, we end up slowly reverting all the way back here, 50% more staffing costs, and then they have to increase their prices, which is why you get inflation after quantitative easing. This is the full process from quantitative easing straight into inflation. This is what happens. And then obviously, inflation, then the Fed comes in, they go, right, this, my friends, is becoming a real problem, right? So they say, okay, let's do this. Now I'm going to do this one with you. This looks like a right mess, but I hope you're following. Drop me a comment if you are. In fact, I'll quickly jump into the comment section, see if there's anything. No, we're all good. Okay, so I'm going to continue on here. And I want to be quite quick. Okay, so obviously, if there's lots of money in the system, there's two different things the Fed can do. They can do quantitative tightening, which is the opposite of quantitative easing. So during quantitative easing, they also buy loads of bonds, mortgage-backed securities, and stuff like this. So then they start to sell. So everyone would have seen the $9 trillion, what was it called? Just balance sheet. It's called the balance sheet that the government has. So during 2020, they bought, and 2021, they bought $4 trillion worth of securities. I won't do that. Yeah, but they bought $4 trillion worth of securities. So now quantitative tightening, this indicates, boom, we got to sell this. So now they're selling. I'll get rid of that. Now they're selling this $9 trillion. And that's at the rate of, I want to say 95 billion a month. Okay. So this is going to mean that we're going to have less money from the Fed, and they're also going to be flooding the bond markets, etc., etc. And so with all of this, extra securities, that means that the price is going to go down of these securities. And so the idea is that we're going to then have less money floating around, okay? Because we're not just buying up dead securities, which is what the government do. In order to kind of print money, they don't just print it. They buy up assets that are pretty much worth nothing, to a company. So a company goes from having something that's worth nothing, like a massive bank, for example. They got loads of debt that's, people can't pay back, things like this. Then the government just buys it and says, look, you essentially had an asset that was worth nothing. Now I'm going to give you money for it. So now that's how the government gives money to banks. And that's how this whole thing, the whole system starts. But didn't want to get too technical. So anyway, we have quantitative tightening. They start selling all their assets, etc. But then we also have the Fed fund rate. So I'm going to call it the FFR. Let me just do this. FFR. So the Fed fund rate. Now, obviously, they're doing, increases. We're anticipating 5 to 7% as the final resting place. I actually believe this is probably going to sit around 5.75. I don't think we're going to get too hectic because I do think we are seeing CPI come in. We're seeing house prices begin to fall in the US. And so I think that, we are going to continue rising. We're currently only at 4% currently. but I think we're going to see another 50 basis point in December and then continue rising probably during 2023. And I think that's where we're going to end up here. Obviously, it depends if inflation comes down, but estimates currently are between this 5 and 7%. To around about mid to end of 2023, and then they'll begin to start coming down, etc. So people are anticipating quite a tough stock market over the next couple of years. But anyway, so we're at this 4%. We've gone up from pretty much 0 to 4 in like less than a year, which is insane. I believe the first one was in March. So this is the current scenario, right, that we're in. And so doing this, you can see obviously, if we raise the Fed fund rate, that then brings us through this massive mess where, yes, they are trying to focus on interest rates, and which is CPI, core inflation. And so they want to get inflation under control, basically, and also unemployment. So then this means that you borrow less money as a customer, because you go to Walmart or you go to Asda and you don't go out buying Gucci. And then this also means that businesses have no money for R&D. They have no money to make their businesses more efficient. Then the prices start coming down for the staff as well. And so they, or even they start cutting staff to try and save money. Hello, Google, hello, Facebook, hello, pretty much every company, which have said, look, we're slashing 1,000 staff. We're going to slash a third of our workforce, etc., etc. So this is all in trying to save money because they can't just borrow it. So I hope that made sense. If you have any questions, do drop me a note. But that is essentially how the Fed has got us into this situation. Oh, and how it affects crypto is it's very simple, actually. It's very simple, because if people are trying to save money, okay, as a business or as a customer, are you going to be buying stuff, right? I.e. speculative investments? Are you going to be buying into the stock market? Because each company, they like to have money in the bank, which they then invest in stocks or something like this. Because imagine you sell 100, you sell like $1 billion worth of stock, you have $1 billion. You can then invest some of that and then you make free money if the market goes up, or you can buy back your own stock. But buying back your own stock, again, which is something they do, is called stock buybacks. Have a look at it. It's just basically, I'm going to buy my stock back because I've made loads of money, which means that the share price goes up. And so we see a lot of this. But now that this is happening less, there's going to be less interest in the stock market. And then therefore, this is going to feed into the overall worry of stock market is going down. And so if the stock market's going down, are there particular areas? Usually in tech, it goes down harder. And then this is typically, it's just a straight line here. Speculation. This is it. And then you get into crypto. And this goes harder, i.e. 90%. So that's pretty much it. And then bonds, they go down a little bit, So they go like beep, beep. A tiny one. But yeah, so it's usually bonds, certain parts of the stock market, tech market falls down harder, and then crypto. And it's just because the more speculation there is, if we know that bonds and stock market is in trouble, then these guys must be in a lot of trouble. And that's just a simple psychology thing about the market. But anyway, hope that made sense, guys. I know it was pretty convoluted and there's a lot of moving parts. If you want me to do anything more specific, let me know and I will. Thank you for watching. See you.